Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brain, sir.
Thank you for having me.
What a fun time it's been over the last week. You and I were there at NASDAQ on Friday, ringing the bell. And
Best day
today,
ever.
yeah, it was a great day. But also today on May 21st, we're recording Wednesday, Bitcoin new all-time high at 100 and almost 110K. Just as we record this around 2 p.m. Eastern, has sold off back to 106.4K. What equity markets down today? A lot of volatility in the market today, both up and down in Bitcoin and in traditional markets. What is the story right now in your mind?
I think we are seeing a breakdown in global fixed income, and you know, whatever market you look at in G10, you've seen a massive move higher in back end yields. The most notable is in Japan, where you've got the 30 and 40-year parts of their curve like well north of 3% now. And that's crazy to think about because, for most of my, trading career, Japan has been in negative interest rate policy, and they have been conducting yield curve control. And so, you're now starting to get to a moment where bonds are kind of in price discovery. And in the US, what caused this, last bit of a flush is a poor 20-year auction that tailed by 1.5 bips. But structurally, like the story around the deficit and spending and the debt has not gotten any better. The most recent, spending and tax bill that's working its way through Congress at the moment most certainly adds to the deficit. And you are talking about deficit to GDP levels that are in the 7% ballpark for 2026 and 2027. And we were told that we're trying to get them to 3% by Besant slowly over time, but it looks like we're going in the opposite direction. And when rates move higher, your interest expense only goes higher, and so you've got to refinance more. And so it's a little bit reflexive in the sense that the higher rates go, the more debt you have to issue to just cover your interest expenses. And then in the UK, you had a surprise higher in inflation that caused the UK bond market to sell off. And in the story in Europe is they're going to be spending more money, and so they have to finance that with debt. And so there's really a culmination of factors that are causing the back end globally to sell off. But just taking a step back from those metrics, like bond yields are still relatively subdued, especially in the back end compared to the front end. What I mean by that is the level of term premium that is in the market right now is not consistent with historical levels of term premium, especially when nominal growth domestically and abroad is expected to be where it's at. And so, like, just on the term premium normalizing to historical levels, like you still have more room for back end bonds to sell off. And so, the fiscal stuff doesn't line up. The supply, just think about this. The U.S. has to fund $2.5 trillion a year, at least on a go forward basis. And where is that money going to come from to buy these bonds? Right. And so ultimately, I do think that, one of the reasons why Bitcoin is at an all time high and that gold is, basically at an all time high is the reality is central banks will have to print money and buy fixed income, right? The money printer will eventually have to go brr. And that is what, these assets like Bitcoin and gold are telling you.
Yeah,
And so it's not
was that
a
the French
coincidence.
version of burr? It was burr. Money printer go bear.
Yeah.
No, I hear you.
And what
Yeah.
makes this all worse though is the Fed can't really act by cutting rates right now because like there's still inflation. You're still talking about core PCE that's well above target. Tariffs are meant to be inflationary, and realistically, if we do believe in the Trump administration's thesis that nominal growth is going to be really high because of all the investment that's going to come into the U.S., like, are you really going to be cutting rates into a nominal economy that's growing at 5-6% a year, right? And if we are really growing like that, you don't think inflation is going to be an issue.
Mm.
And you're still dealing with a fairly tight labor market, although there are some signs of deterioration. And so the Fed's on hold, so that they're not cutting rates. And you have all this pressure on the back end. And so it's really culminating to really kind of test the government's resolve on what they're able and willing to do to defend the back end of the curve.
Yep. Yeah, and it has been just a straight up. I mean, Secretary Besson was talking about his 333 plan, right? That there was all this talk about how crucial the 10-year, but the long bond anyway is, and they have not been able to get it down. It went down as low as what 3.8% the 10-year at first,
Yeah.
and it's just been grinding higher since then. But you're saying too, this is the world's governments, right? It's not just the
It's the
U.S.
world, but here's
Yeah.
the thing. It's one of those things where, as a collective of like investors and money managers in the world, like everyone knows that the fiscal path is unsustainable, right? And so Paul Tudor Jones describes it best. It's like being in an arena watching WWE. Like it's fake, right? And there might be like a moment where everybody realizes, like, at the same time, like, oh, this is fake and productionalized. Like, why am I buying into this as if it's real? And so the question is, are we getting closer to that moment?
A full
And
realization, basically.
yes, and then, but ultimately, like what has always happened is central banks step in,
Yeah.
right? Treasury does buybacks. Yellen issues less back end bonds and more T bills. We improve the regulatory hurdles for banks to own more fixed income on the balance sheet, right? These are all things that effectively kick the can down the road,
Yeah.
but don't get to like the core issue, which is we spend way more money than we have. And in a positive interest rate world, like, there is a limit to how much you can effectively borrow in terms of ultimately being sustainable.
Right.
And so I think the market is waking up to that. And I think Bitcoin and gold, are the clear kind of winners in a breakdown in confidence in treasuries. But realistically, we're all losers in that scenario.
Well, you can try to
Unfortunately.
protect yourself, and it looks like more and more people are, with both gold and Bitcoin doing great this year. Bitcoin with a lot of volatility, but it's been going on for a couple of years too. I remember us talking on this show over a year ago about how the bond market and gold were flashing really troubling signs for this, like, that Wall Street had figured it out. Finally, the gold bugs day had finally come. The markets were finally realizing and starting to price the unsustainability of the fiscal pathway. The new budget that's, like you said, working its way through Congress was the impetus for the Moody's downgrade. Finally, now all three major credit ratings have downgraded the U.S. ratings agencies because it adds a trillion plus of new deficit spending. It doesn't cut; it
I
adds.
mean, it's more over, like, by 2030. Like, I think the figures are
Yeah.
like closer to like $3 trillion by 2030, which is a lot.
Do you have any confidence long term that the way the U.S. political system is set up, that anyone will be able to make these hard choices, or is the
No,
4, and
no,
6 year election cycle make it impossible to justify austerity? Basically,
nobody wins running on austerity.
yeah.
You can't win a political election being like, I'm going to send you less money.
And
People vote with their
not just
wallets.
that, I might also
And
need to take more from you as well.
correct.
Yeah.
And so it's like, oh, I'm going to tax you more and I'm going to, spend less on you. Like, that's not a winning argument. And when you have congressmen that are on 2-year election cycles, right? Like, it's impossible for somebody that is focused on reelection, basically like 6 months after they get their job, for them to think structurally about what makes sense from a policy standpoint for the next 6 years or 8 years, right? And so nobody has the political capital to actually deal with these structural issues. Now, one would argue that a second term president does, right? And I honestly applaud Trump and the administration for making an initial attempt at basically being like, we need to cool the economy to get rates down, to be able to finance our debt better, and to get debt to GDP to somewhere closer to 3%. But ultimately, what happened was, when you do that, that's going to take down risk markets. And S&P and NASDAQ rolled by 20+%. and all of a sudden, the administration policy kind of flipped a little bit. And so, like, they basically got stopped out, and even a second term president has a stop out level with this stuff, because realistically, like, markets are incredibly complacent right now, and don't take my word for it. Jamie Dimon said it this week, right? The multiples that some of these companies trade at, like the ridiculous valuations across all asset classes, right? And so there's a lot of froth, and people will get hurt if we do the right things, right? The right thing to do is to get deficit spending lower, to get your debt to deficit ratio to 3%, or deficit to debt ratio to 3%. That is the long run sustainable average. Like, that's what you should do. But cutting spending by that much, like, you're not going to help risk assets, like, by definition, right? And so, like, we have some hard pills to swallow, and I don't think anybody has the appetite to swallow those hard pills. And so what's happening is the market is forcing the issue.
Yep, it is. Well, let's keep it. Man, this saga, it turns out markets, they get ever more exciting the longer you watch. Beimnet Abebe from Galaxy Trading, my friend, thank you so much.
Thank you for having me.